All right, good afternoon. Let's start our webinar. I'm Randy Sadler with CIC Services, and I hope that everybody's having a fantastic week. Our webinar today is titled Tumultuous 2020 Highlights Obvious Need for Middle Market Companies to Own an Enterprise Risk Captive. This is a CIC Services team. If you get a look at everybody's smiling faces, we are a captive insurance company manager in Knoxville, Tennessee. And this is me. I'm your host today, Randy Sadler. I am from Knoxville, Tennessee. I'm a principal here at CIC Services. I really tell everybody that I learned risk management essentially when I was in the Army after graduating from West Point. I was a tank commander for 5 years and served in various roles in a tank battalion. At one point with the headquarters company, I had 300 soldiers, 150 wheeled and tracked vehicles that I was responsible for their safety. And so that is really where I learned risk management. That's where I cut my teeth, so to speak. Worked in multiple Fortune 50s, and I've been at CIC Services 8 years. It's been fantastic being here. In the time I've been here, we've essentially tripled the number of captives that we have, that we manage. It's very exciting because it shows the power of owning your own insurance company. What we're doing is really helping companies protect their business and their hard-earned wealth. So a little bit about CIC Services, just so you know. We are what's known as a captive manager. We help businesses set up and own their own insurance companies. We run those insurance companies for them. We really specialize in the small and middle market. So we help middle market business owners protect their businesses and hold on to their hard-earned wealth. Because we're very entrepreneurial ourselves, we definitely understand the kind of the unique needs, goals, fears that businesses have in the middle market, the challenges they face that are unique as well. You can see in the right bar, we have won quite a few awards. We've been finalists for the U.S. Captive Service Awards for Captive Management Enterprise Risk Captives, and we are an ICCIE trained organization. The ICCIE is really the only accrediting body in captive insurance, and we have quite a few of our members that have their ICCIE certification. So if you work with us, you're definitely going to be in good hands. So a little bit more about us. When I say we help businesses own their own insurance company, it helps establish asset-protected loss reserves. So an insurance company accumulates reserves to pay potential claims, but that tends to be asset-protected if done properly. We also help businesses increase their profit or wealth, generally by millions of dollars. Most of the businesses we work with, after several years, they're definitely millions of dollars to the good. We do help lower and control insurance costs, insure uninsured or underinsured risks like COVID-19 as an example, and then also benefit from insurance company tax treatment. So many of our clients are able to do all of these things. So let's start by talking about what is a captive insurance company. This may be a refresher for some of you, but it is a real insurance company. It does everything that a real insurance company does. The biggest exception or difference between a captive and, say, a State Farm is that a captive's license is limited. It's limited to insuring business or related entities. So if you formed a captive insurance company and decided to write auto insurance for your neighbors, it wouldn't be long before the state threw you in jail, and that's because they have a consumer protection interest. But you can insure your own business. Captives have been around since the 50s. They're used in virtually every industry segment. 90% of the Fortune 500 have a captive, so that gives you a sense on their proliferation. And then what do? Well, they can replace commercial insurance, and this is one way to control cost. We have a lot of programs that do that. And what we're going to focus on today is they can insure enterprise risks. And very often we describe that as an enterprise risk captive. They can insure warranties. They can issue bonds. They also can do health insurance or take a portion of your health insurance employee benefits. And then a note at the bottom, and this is really important for middle market companies in particular, any combination of the above. So a captive could replace some commercial insurance, insure some enterprise risks, and cover some health care. And by layering all that together, you actually reduce the fixed cost of running and owning the insurance company, making it even more efficient. All right, so with that, I'll pause for a second for any questions. We're just really warming up here and about to get to the meat of the slides. All right, very good, no questions. So let's talk about why should business owners consider owning an enterprise risk captive insurance company, or ERC, enterprise risk captive. Well, first of all, the greatest of ironies, 2020 was a year that no one saw it coming, right? We've had COVID, we've had riots, we've had statues torn down, we've had entire city blocks blocked off where businesses have no access to their business. This has been quite a year. And consider first, small mid-market businesses are fragile, right? Unlike a Fortune 1000 business, they don't have the same access to credit and capital. Many of them are geographically concentrated. They may have a concentrated revenue stream. So, Target may have had a few stores in Minneapolis blocked by riots, but the rest of their stores were doing just fine. And so if you consider, how many Fortune 1000 companies were bankrupted by COVID-19 or riots, with the exception of maybe the airlines who the federal government bailed out. There really aren't any, but how many small mid-market businesses have been bankrupted? A lot have closed. Whether it was COVID, whether it was riots, there's just no way for them to claw back, and they quit. Second, consider that 40% of small businesses, if they're hit by a natural or human disaster, never reopen their doors. Now, notice it's kind of interesting. I was at a conference a few years ago, and the world had just crossed the tipping point where human disaster was equal to a natural disaster and was expected to keep growing. You think about the disasters human caused, terrorism, spreading disease, cyber, car wrecks. So we have gotten really good at messing things up. And so, and now we rival and are surpassing natural disasters in the damage that we cause. And so it's really important for businesses to account for all the ways that their business can be interrupted either by natural disaster or human disaster. And a lot of businesses don't make it to the next generation. And that's, and by the way, we'll be glad to send you these slides. I forgot to mention that at the beginning. So don't feel like you've got to get everything down. And then finally, consider this. Our own U.S. government encourages mid-sized businesses to prepare for a wide range of threats. This chart comes from ready.gov. It's not my slide, it's theirs, but you'll notice there's a lot of risks that they want businesses to be prepared for. And many of them, businesses often don't insure commercially. So you might consider those enterprise risks. Some examples might be cyber or supply chain as an example. Utility outages, notice pandemic disease. Wow, nice foresight there. Workplace violence, terrorism, or some on this side. If you come over here to the interruptions that it causes, assets at risk, loss of key people can really hurt a business. Supply chain interruption, as I mentioned, business operations, reputation. Very often businesses don't realize their reputation can be damaged very easily, even by people who are just lying about you. So that's a huge one as well. The point is that many businesses are vulnerable, and there's a lot of vulnerabilities that often are not insured commercially. And don't trust me, trust our own federal government at ready.gov. So when you think about 2020, what 2020 really tells most middle market business owners is we really need two things when we're thinking about our business. We need more insurance and we need more money, right? I mean, if you had, if you could have seen the future and looked at 2020, you would have done some things differently. But for many business owners, they definitely would have figured out a way to insure more and to have more money set aside. And that's really is what businesses can do going forward. So let's take the lessons we're learning now, let's apply them going into 2021 and beyond. Let me just pause right there and see if we have any questions. You can throw them in the chat bar or you can unmute and ask. All right, very good. So let's jump in. What is an enterprise risk captive or an ERC? So let's start by defining enterprise risk management. This is a discipline by which an organization or industry basically they assess every threat they have, whether it be physical, whether it be financial, whether it be people, and look at all of those sources and then think about where the organization is best prepared to protect itself. So there's a wide range of ways that businesses can protect themselves from risks. They can set aside reserves, for example. They can insure risk commercially. They can insure risks in a captive. They can put plans in place to mitigate risks. And there may be some risks that they just simply are aware of but choose to ignore. If it happens, they'll just deal with it when it comes, right? So that's really enterprise risk management. It's really laying out all those risks and then putting a plan in place to protect the long-term value of the business and not let it get disrupted. All right, so when we think about enterprise risk management, then we're going to put risk into some categories. And there's really three: core risk, operational risk, and strategic risk. And when you think about core risk, these are typically areas where a business has to have insurance. For example, if you're going to drive on your state's roads, you have to have auto liability. That's a state requirement. You have to have workers' comp insurance. You don't get a choice unless you want to break the law. You also, if you have a mortgage, you have to have insurance that's with a rated insurance carrier because your bank requires it. So you have a pretty good feel there for what core risk is. Now, operational risks are risks that are inside the business, theoretically in the business owner's control, and strategic risks are risks that are outside the business, theoretically outside the business owner's control. So think of them as existential outside risks. The point is, all three are important, and all three can be handled in a wide variety of ways, but today we're going to focus on an ERC for addressing these risks, okay? So here's some commonly uninsured risks. Now there's a lot more, and I'm going to cover a few more, but it's not uncommon for businesses to be unprepared for litigation, as an example, especially if it falls outside of some of their insurance policies. Supply chain interruption is a huge one. Receivables. It's not uncommon for businesses to be uninsured for receivables, and then when somebody doesn't pay, they get caught holding the bag. Cyber, even commercial cyber policies, if they are in place, very often have a lot of exclusions. Very often they exclude human error, and as you know, most cyber problems are actually caused by human error. Somebody clicks on a link, and then it opens up the entire system to be looked at by somebody outside. Fines. So government intervention in your business to fine you, shut you down. Very difficult to insure in the commercial market, but it is an uninsured risk. And of course, reputation, right? Reputation damage can be very powerful. It's also difficult to insure commercially, so it's often an uninsured risk, okay? And then there's what we might call underinsured risk. And a classic example of that, where businesses thought that they had insurance, is when COVID-19 came. Many businesses thought their business interruption policy would cover it. But for the vast majority of companies in America, business interruption is part of their property policy. And normally, business interruption is only triggered if there's actual property damage. Well, that can be a really big problem, because if your business is interrupted and you don't get revenue, then the business is in deep weeds, as many of you know. And we're going to talk a little bit about that when we think about an enterprise risk captive. So let's think in a little more detail, because here we've separated out some operational and strategic risks that are commonly either uninsured or underinsured. I'm going to cover a few of those. We won't spend a ton of time on them, but I do want to go through a few. So administrative actions is a government agency coming in and fining the business, right? And that actually can be insured. And not only the fines, but also the interruption, the time lost, the money lost in the process. Employment practices is an employee often suing the business or bringing harassment charges, or it doesn't always have to be, very often the employee could be making it up, as many of you know. Litigation defense speaks for itself. Receivables we talked about. Commercial crime. Short-term disability. Very often businesses rely on some key people that if they're out for some period of time, the business needs money to offset the lost revenue or the impact, right? Cyber we spoke about. Many cyber policies really don't cover enough, and so a better cyber policy is needed. Reputation risk, very important. Product liability. Some businesses have products and just don't have them insured. They could insure them in an enterprise risk captive. Certainly errors and omissions, and then deductibles on commercial insurance policy. So those are some operational risks. That's not all of them, but that's a good rundown. Let's think about strategic risk. How about business interruption? So we have a contractor client that had essentially 85 days they couldn't work because it would rain, clear up, rain, clear up, rain, clear up. Their contract had a $1,000 a day penalty, and they literally could not get the job started. And so when they started out the project, they were $85,000 already in the hole. They had an enterprise risk captive. They had business interruption due to natural perils, and it paid the performance loss that they had. Key contract termination. So some businesses have key contracts in place that are very valuable. I just talked to a physician group this morning. Some of their biggest contracts are with insurance companies, health insurance companies. If one of those was canceled, it would put a huge dent in the business. Loss of a key customer or key account. This can put a significant dent in revenue. Subcontractor default for insurance, for construction companies, or anybody relying on subs. Losing a key employee. We had one client that had an employee that left, and this client was one of their top salespeople and took a lot of their customers with them. Their enterprise risk captive did pay for the loss. It also gave them money to fight a lawsuit to try to block the employee from taking their clients away, but they still lost revenue. So you can imagine the impact there. Losing your franchise, that may seem a little crazy unless you lived through 2009 and watched General Motors cancel franchises. That would be a huge hit if you were a car dealer. So that is a possibility, for example. Certainly terrorism, supply chain interruption, business indemnity. I'm going to come back to that one. It's really a contract risk. Sometimes businesses enter into a contract, they think they're getting one thing and there's something in the contract that doesn't go their way or they misunderstood it. And now it causes them to have losses. So as long as they legitimately erred in doing so, business risk indemnity, contract risk can protect them. Notice I've got pandemic disease here. Many captives do cover for pandemic disease. Regulatory legislative change. This is a government agency coming in and changing the law on you, which impacts the business and causes you to lose money or close. And this does happen, by the way. Many of our clients were affected by COVID. Either the government shut them down and they were able to file claims and have their claims paid, or they had broad form property. Now, remember I mentioned that property insurance normally required the property to be damaged for the claim to be paid for business interruption. So if you had your property blocked by rioters but not damaged, then you really don't have any help, right? And during COVID-19, businesses did not get business interruption insurance. Now that may go to court, and we'll see and how that plays out, but nevertheless, right now they're not covered. So broad form property is really an add-on insurance policy that doesn't only cover property damage, but business interruption tied to loss of access to the property. So there's many ways you can lose access to the property without it being damaged. And so you can see just the importance of addressing these uninsured or underinsured risks in a business. Now, that's a lot of risks, right? Wow, it's a lot to cover. I'm not sure how we're going to do that. And a lot of businesses, they face a fork in the road, right? Am I going to insure these uninsured, underinsured risks, or am I not going to insure them? And a business owner normally faces a conundrum, right? If they don't have claims on their commercial policies, right, then the premiums they paid are a sunk cost. So how are we going to solve that conundrum? Well, if a business doesn't have claims on their captive insurance policies where they own their own insurance company, then those premiums paid aren't a sunk cost. They are sunk profit, profit in the insurance company owned by the business or business owner. So we're going to turn sunk costs into sunk profit. And then this fork in the road, the business doesn't have to leave those risks uninsured, underinsured. They can actually insure some of them in their captive insurance company. So let's pause right there. Any questions? All right, very good. Let's keep going. So this is a typical captive insurance company structure. Essentially, the business owners or shareholders are at the top. And you'll notice they own their business or businesses, and they also own their insurance company. And so the business pays premiums to the insurance company, transfers risk to the insurance company owned by the business owner, and the insurance company in turn provides insurance policies to the business. This is a contractual assuming of risk of the business. And captives, have if you follow the money, if you will, the flow of funds, and I've got the dark arrows here. As the business pays premiums and transfers risk to the captive, it moves money into the insurance company. Obviously, that turns into assets under management. If that money is not paid out in claims, those sunk profits are assets that need to be invested. Many of our referral partners that we work with are trusted advisors to their clients. Many of them are asset managers, and captive assets are something that many asset managers enjoy managing because it's very sticky money. It's money that is inside of an insurance company, and the client's typically not going to reach for it and blow it, right? And they're not really able to because it's in an insurance company. It has to be there to pay claims. So let's talk about reinsurance for small captive insurance companies, because it can seem a little daunting to think about insuring these things. What if something happens? Well, in an enterprise risk captive, and not all enterprise risk captive structures are the same, we're going to backstop the captive with a pool. And so I'm just going to give you a quick rundown on essentially how CIC Services does it. Other captive managers may have a different approach, but the point is that the captive isn't standing on its own, right? So here we have, again, the shareholders, the business owners. They own their business or businesses. They buy insurance from their captive, and that captive is going to share some of its risk with a pool. Now, some of you may be familiar with reinsurance, and with reinsurance, you buy reinsurance. If nothing happens, the money's gone. The beauty of pooling, it's a bit like a co-op, if you will, is that the captive shares risk with the pool, and then whatever money's not paid out in claims, a fair share portion comes back to the captive. So by co-oping versus just buying straight reinsurance, the captive ends up getting most of that money back, right? For our purposes, we're going to have 80 captives in the pool, and I'm going to talk through what that reinsurance arrangement might look like. And the best way to do that is to talk about a claim. So why ERC? Here's an example of an uninsured loss, right? The business has a loss that's not commercially insured. Let's say that your client or your business has a $400,000 COVID-19 business interruption loss. And of course, you got your PPP loan, but you still lost a lot of money, for example. Normally what happens? Well, that loss is paid out of operations, maybe out of retained earnings, maybe out of the owner's savings. Nevertheless, in many cases, wealth is destroyed. Sometimes employees get laid off, but the outcome is negative, without a doubt, right? Now let's take that exact same business, that exact same loss, but instead, the business has an enterprise risk captive, an ERC. And this is an insured loss. So the business has that $400,000 loss, and they file a claim. And so we, CIC Services, send out a third-party adjuster. They verify the claim is real, verify the actual amount of damages, and once that claim is approved, the captive pays $400,000 to the business, right? And in this situation, we're showing just a 50-50 pooling arrangement. So the risk pool picks up 50% of the risk, and the captive picks up 50% of the risk. So if you own a captive, it's almost like having a 50% deductible policy, right? So it's big help. But think about what really just happened here. The $400,000 went to the business. Now, if this captive's been in existence for a few years, some of that money probably would have already been gone in taxes in the past, and I'll explain that in a few minutes. So not only are old taxes paying this loss, but the reinsurance pool is paying half the loss. Big help when needed, right? And what we have found this year, interestingly, is we have clients that COVID interrupted, and they've benefited from their captive paying the loss. On the other hand, we have clients that have a captive that COVID's actually helped them. Construction companies are on fire, for example, and businesses in, say, sanitation or cleaning, they're very busy. They're actually making more money, not less. And so at a time when they don't have need, the insurance companies are helping the businesses that do have need. And that is exactly what insurance is supposed to do. And it works with enterprise risk captives and pooling. Now, just for perspective, let's think about you know, this $200,000 the pool paid. That sounds like a big deal. But we're going to spread that across 80 captives pro rata based on their amount of premiums paid. Each captive that's not part of that loss is paying a couple $1,000s, and the benefits to them of their insurance and all the other benefits of a captive, including the tax savings that they experience, will far eclipse the amount that they pay out in claims for other people. But the protection is there when they need it, and 2020 is a year when we're all realizing we definitely need it. What happens to assets in a captive that aren't paid out in claims or expenses? The owner keeps everything, right? So it's an insurance company full of money, and the owner gets to keep it. So what questions does anybody have now? We'll pause for a second. You can put a question in the chat bar, or you can unmute and ask a question. Very good. So now we're going to shift to taxation of captives. And really, this is a huge feature that helps an enterprise risk captive build up the reserves it needs to protect the business. So traditional or larger captive insurance companies, essentially their taxation works as follows. Insurance companies receive premiums. Their actuaries do calculations and determine the amount of money to reserve for losses. They don't pay taxes on those reserved funds for losses, and that allows them to invest and grow a huge pot of money. And this is why when you drive into any major city and you look at their skyline, typically the three biggest buildings are insurance companies, banks, and football stadiums. So if you could get money, be taxed at zero, invest and grow it, you usually would come out ahead, right? And that's exactly what insurance companies do. Well, in 1986, and it's hard to imagine, 86 was 34 years ago. That was a long time. I was in high school then. So in 1986, Congress passed the Tax Reform Act of 86, and they created the 831B tax election. And this really was designed to help small, mid-sized businesses insure themselves. And we were going through an insurance crisis in the United States. We're actually starting to have an insurance crisis now, where markets are hardening and many businesses are having a hard time getting insurance. And so the intent was to incentivize businesses to protect themselves. And the way they do that is own their own insurance company. And as long as the business pays premiums of $2.3 million or less to their insurance company, then their tax rate on the profit in the insurance company is 0%. And so this enables business owners and businesses to amass reserves to protect the company. So it's a very powerful financial benefit for your clients to help them protect their business. So let's talk about an enterprise risk captive insurance company scenario. We have here an annual P&L, for example, and the business has all their risks evaluated, and then an actuary prices that risk, and the business decides to insure itself across a broad spectrum of threats, many of the ones that we covered earlier. And let's just say that the pricing comes back, I'm using round numbers, of $1 million of premium that they pay to their captive. And there's some claims by the captive in the pool that year. And then we have some costs to run the insurance company, leaving an underwriting profit of $900,000. As you can see from our earlier illustration, that creates tax savings via the 831B election of $360,000. So that allows the insurance company to hold a larger reserve of funds, right? And the insurance company needs those funds for potential claims. And so that's exactly what the 831B election is intended to do. So let's take it a step further and let's think about a 10-year period, right? So enterprise risk captives, an ERC, enhances long-term viability. So we've got two businesses here, exact same business, exact same time period. The business on the left has some commercial insurance in place, right? And they have $1 million a year that they can allocate. These are profits that they can deploy, and they choose just to pay taxes on them and save them. So the business on the left over 10 years would have $5.9 million. The business on the right also has commercial insurance, the area in gray, but they decide to deploy $1 million of their profit to protect their business. And so you'll see here, we've listed a lot of insurance policies, and they likely would have more than this. but the business is protecting against a wide range of risks, many of which I spoke to earlier. And in that same 10-year period, the business on the right has 10.7 million. So almost $5 million more dollars and all this insurance coverage. And I always, let prospective captive owners know that this is really what I describe as captive math, right? There's very few places in life where you get more of two things. You usually got to give up something to get something, but by owning your own insurance company, you actually have more insurance and more money. And so over that 10-year period, which business is better suited to survive uncertainty? Well, it's pretty obviously the one on the right. And which business deployed a portion of its profits wisely or more wisely? In many cases, it would be the business on the right as well. And so here is a little more laid out model, and I'd be happy to share this with you on a call if you want to go into it. A little more detail on what I just showed you. This informal self-insurance is really the business on the left, right? Taking that $1 million, paying taxes, and accumulating 5.9 million with investment returns of about 6%. The business in the middle, exact same money, but now the business is using it for insurance, and they accumulate 10.7 million. Notice we're showing claims here as well. And then on the right, the same business owns its own insurance company and implements a hedging strategy, which is really a strategy designed to reduce downside risk of the assets in the captive. And this business on the right has a little bit less accumulated reserves to pay claims, but is able, because of that strategy, to access a lot more money should the business decide to sell or move on. And let's face it, many middle market companies, at some point the business owner is ready to sell, or the owners are ready to sell, or they're ready to retire, or they want to pass the business on to their heirs. And once the insurance company is no longer protecting their business, any money left in it is their money, right? So one of the things that business owners are always going to be interested in is, if I go to the effort to protect my business, how's it going to benefit me later? So let's just think about that $1 million a year into a captive. Let's just say over 10 years. That's a hypothetical example. It could be 1, it could be 20, just depends on the business owner's needs and how long they're protecting their company. And then let's let that money grow and turn it into an income stream. Well, in the informal self-insurance, where we have no captive, business owner basically has $1 million a year for 10 years. They pay the taxes, they invest it and get a 6% return. They wait a few years, and then they start drawing their money out over a 20-year period. So my little chart here is going to skip a few years, but you'll notice that they get $700,000 a year for 20 years, right? $710,000 a year for 20 years. That very same business owner, had they protected their business with a captive, had all that insurance protection in place, which is very powerful, as you already have seen with COVID, with riots, with who knows what's next. That same business owner, exact same timeline, 10 years of the captive, and then taking money out over 20 years, with the most expensive exit, which is paying a full capital gain exit, has $900,000 a year for 20 years. Same investment returns, just significantly more money in the future, whether it's for retirement, whether it's for traveling, whatever they want to do with it. Now, that brings us to our hedging strategy, which is in the far right column. And the hedging strategy is a little more advanced strategy, and I'll just give you a little bit of a fly overview. We'd certainly be happy to schedule time with you and go into more detail. But in the hedging strategy, the business is going to surrender its insurance license in the captive. It's no longer an insurance company, and we're going to borrow the money out instead of taking it off. The point really is that there are a wide range of options between here and here that a business owner can consider. And so there's a lot of ways that the business owner will come out ahead or be rewarded, if you will, for protecting their business with a captive insurance company. And remember what I alluded to earlier, Congress wanted business owners to protect their business because middle market companies really create jobs. This is the job engine of America. So what are the benefits of an ERC or enterprise risk captive? Certainly survival, right? Having extra insurance to protect the business, plugging holes in the commercial policies or replacing the commercial policies. By looking at risk with a much closer lens, we have a stronger business model, improve risk management without a doubt. In many cases, improve cost control. The captive can help lower commercial insurance costs. We also have the ability to keep insurance profits. Remember that insurance is normally a sunk cost. Now we turn it into a sunk profit in the captive. There is always an asset protection component of an insurance company in that it's hard for a creditor to attach to it. Wealth accumulation for the business owner, and then that favorable tax treatment that's designed to help build up loss reserves, all working for the business's survival and the business owner's survival as well. So as I mentioned, when you got the email telling you about this webinar, what 2020 really shows is that businesses need more insurance and more money. Those are the benefits of an enterprise risk captive. We know of no other vehicle that will do this, and believe me, we've been on the lookout for it, and it's not there. Any questions at this point? All right, we've got a pretty quiet audience today. That's okay. So what's in it for you as the trusted advisor? Well, first and foremost, deepen client loyalty, right? If you are able to help your clients use an enterprise risk captive to protect their business, they're going to deeply appreciate what you've done for them. They'll have more insurance and more money, and you will be the advisor that brought this to them. Very often, in addition to deepening client loyalty, we do work with quite a few advisors, trusted advisors, who are trying to find a new client or add a new client into their mix. And this is a strategy that you can introduce to them. And I'll be happy to have a call with you to talk through how to share this with them and how we can help you. I did mention this, sticky assets under management. So if you are an asset manager, this is a fantastic way to manage more assets that usually don't get spent on a boat or a vacation house, right? They're in an insurance company and they can't just blow that money because it's regulated. And then the other is captive management fees. So we work with trusted advisors and we do share a portion of the fees inside the captive with you. And so even whether you're a CPA, whether you are a wealth manager, a property casualty insurance agent, there are fees that we can share with you. Very often I've noticed sometimes property casualty insurance agents might be a little nervous about introducing an enterprise risk captive. The reality is, in many cases, the client's going to keep their commercial insurance with you. Then they're going to add extra insurance. And so in the vast majority of cases, property casualty insurance agents that we work with make more money, not less, because now the client sticks with them longer. And they're able to make those captive management fees in addition to their commissions. So it is a win-win-win on all fronts. All right, let's pause here. We've got a question popped up in the chat bar. Very good. Is this safe for clients given IRS challenges? Very good question. So the IRS has certainly attacked captive insurance companies, and there's been a lot of developments in this space. I think there are several things to consider. The first and foremost is it's important to have a defensible structure, and I'm actually going to back up here. Let's go back here. So when I'm showing you this 50-50 risk pool, this lines up with the IRS's safe harbors for risk distribution. There are three captive cases where the captives lost in tax court. All of them had what's called a layered pool, and by layer, what I mean is that if the captive had a $200,000 or $300,000 loss, it would essentially pay all of that. It wasn't until $250,000 or $400,000 or $500,000 the pool would even help out. And so they didn't have actuary pricing of how that layering was done. And essentially, that creates, if you will, notional risk shifting. At least that's what the courts have ruled. Now, I can tell you that some of those captives are in appeal. We hope that they get overturned. But by having this first dollar sharing, like I'm showing here, every dollar the captive pays, the pool pays. There's no doubt there's risk distribution here. So we think that it's really important to be in a good structure. Another thing that's important is actuary pricing. So if you look at tax court cases, in some cases there was some exorbitant pricing in the Avrahami case, several $100,000 for terrorism insurance in Arizona. So we think it's important to have actuaries that are either an expert witness for the IRS or very familiar with what the IRS looks at in actuary sciences, if you will. And it's also important to have a domicile that's going to look at the work done by the actuary. So we would recommend, I didn't really cover this, but a captive gets a license to write insurance. It normally comes from a domicile, and a domicile might be a state, it might be an offshore entity. So insurance is not regulated by the federal government, it's regulated by the states. And so states issue licenses. We like to work with states that have their actuaries double check the work of the actuary doing the insurance for the captive. That double check, if you will, prevents a lot of the risk of having sky high pricing or something that can get shot down. And you want that US regulator in your corner. If the IRS says your pricing is bad, you want a US regulator to say, no, it's good. I've been in insurance 30 years and I approved it, right? That's going to be much more powerful. Hopefully that answered your question. I'll be glad to speak to you more about it offline. We got one more in the chat box here. Let me pull that one up. Okay. How were COVID-19 claims paid? Did the commercial property policy not have the virus exclusion? Good question. So yeah, so hopefully I answered this. Many of the many commercial policies have a pandemic or virus exclusion. Many commercial policies only pay for business interruption if the property is actually damaged, as I alluded to earlier. I'm going to go back here on the slides a little bit. So remember, one of the advantages of an enterprise risk captive is that, in a sense, by writing a broader array of risks, and importantly, and I didn't allude to this, but I will now, the captive insurance policies that we write are normally going to have fewer exclusions, right? So if I pull up my homeowner policy and I look at the section called exclusions, I got to read all the way to double S, right? Before it stops. So there's all kind of situations where they won't pay, right? So in our captive policies, we're going to have far fewer reasons that we won't pay. And so it's far more likely that if the business has a loss, that they're covered. Now, this does cause the policies to cost more, but since you're buying insurance from your own insurance company, that's a risk you're willing to take, right? And so many businesses are. So that's that combination of fewer exclusions, a broad range of policies. And then if you think about it, that creates more triggers, more times when the policy can work. So when the pandemic came, even if you didn't have pandemic disease, if you lost access to your property, a broad form policy would step in. If the government closed down your city, then regulatory legislative might step in. But by increasing the number of triggers, it makes it possible to get your claim paid when you have a loss in a much wider range of circumstances. Hopefully that's helpful, and I'd be able to be glad to address that more on a call. All right, we got one more chat question. Let's see here. Pull that up. How long has CIC been a licensed manager? Who owns CIC? Do you have a preferred domicile? CIC Services has been managing captives since 2005. It's essentially when our company started. We're licensed in multiple domiciles or approved, really. We're an approved captive manager. So we're an approved manager in Delaware. We're approved manager in North Carolina, Tennessee. We're working on getting approved in Connecticut. We like Tennessee, North Carolina, both because they have a very nice balance of regulating captives but not over-regulating them. So there are some domiciles that work largely with large companies. And so, you know, when you're in a large company situation, we kind of have my lawyer talk to your lawyer, so to speak. And with the, you know, that creates extra red tape, extra cost, if you will. And so there's really, it's better to find a domicile that's got the right balance, understands mid-market companies can't spend thousands and thousands of dollars on lots of red tape. On the other hand, there may be domiciles that under-regulate. They issue a license and don't look very closely. We like domiciles that look at the risk distribution structure. Tennessee, North Carolina do that as an example. We also like domiciles that double-check actuarial pricing, really review policies being issued. We think it's important to have that level of scrutiny, but not you know, unnecessary red tape, if you will. All right, very good. Thank you so much for joining today. If you have any other questions, let me know. I did have put up here real quick. There we go. So yeah, here's my email address. If you'd like a copy of the slides we covered today, just send me an email. I'll be glad to send you the slides. If I can help you in any way, let me know. We did have one more question. Since pandemics affect most businesses at the same time, how will the exposure affect the pool? Great question. I think I'd covered this, but many of our clients actually have not been hurt by the pandemic. So the pandemic has been it's either created winners or losers. So we have construction companies that are going gangbusters and don't have claims. Companies that are in sanitation, companies that are in you know, cleaning, selling cleaners are doing great. Grocery stores are rocking, restaurants are sucking. So essentially those, what we have found is some of our businesses have filed claims and others are doing just fine. And so we do expect to have more pool losses this year, without a doubt. But at the same time, you know, that's what the captive's there for, right? It's to get businesses through the hard times so they can protect those jobs. And all of our clients are definitely experiencing that this year. Those that needed help got it. So the captive's doing what it's supposed to do. And next year it may not be a pandemic, it might be something else, you know, who knows? We could have a, you know, electromagnetic pulse knock out an entire part of the country for a while, or a large utility grid go down for a terror attack. It's just, we just don't know. But the key is to be protected so that the business can survive. And that's really what we're trying to do. All right, good. I got a few notes saying thank you. Really appreciate that. Again, if I can help you in any way, send me an email. Randy@CICServicesLLC.com, and hopefully you'll be able to join us in the future for other webinars. Everybody have a fantastic rest of your day.